Welcome to the Final Bar. I'm Greg Schnell, the host of the show. This is the show where we check out the most interesting charts to get set up for the following week. With some intermarket studies, we'll be finding out the inflection points for minimum risk and maximum reward. And we've had a rally, so that makes it a little more fun than we've been living through lately. Our agenda today, I'm going to just cover off a couple of things. We have a new market summary page. The FANG stocks didn't do very well this week. We had a big rally yesterday, but today they performed poorly, didn't really follow it up. So we're kind of watching those very closely to see if they need to go retest their lows. And the overall market is up against the 10-week moving average now, and we're going to talk about why that's important. Crude oil and the problems ahead might have got better this week, but I'll discuss that when we get to it. So let's go start into on the charts. First of all, StockCharts has put the For Dummies book that I wrote for sale for $0, and you can order it today, only today. I think it'll be sold out by today. You can order it today and only pay the shipping costs. So doesn't get much better as an offer than that. And we blew through half of our inventory in a few hours once this was launched. So I would say if you want it, click it and get it in because it's pretty important. And how do you find the StockCharts store page? At the bottom of like the members page or whatever, you can find it here, and you go down and here's your StockCharts store right here, and that'll take you to the main page. And then from the main page, go down, and in this case, you're looking for the For Dummies page, and click on that. That'll bring up the books, and then click on this one, and that'll get you a book for free. So anyway, just so you know. I wanted to cover off the new market summaries page because I think it's a huge improvement over what we had before. And one of the things we've got now is you just tab through these and it'll give you a picture of all of these different charts. And I think it's particularly helpful. You notice that most of the indexes move the same. So if we scroll down to sectors or to something like U.S. industries, this is quite an interesting thing because you can just see the shape, and as you click through these, you'll notice, that the banks hadn't rallied as much. And if you go to the biotechs, you'll see, you can kind of compare who's bouncing, and this broker dealer's been ugly for a while. So then you can just click on that chart, and it comes up with your standard default settings. But if you were going to expect the broker dealers to fail, it's probably right in here or right up around that 200-day moving average. So we are spitting distance away from some place you'd expect to fail. And typically broker dealers are a leading industry. So if they're going to start to break out to the upside, that would be a little more bullish. If they got stalled right here, right now, then we'd probably say, gee, who knew? So anyway, keep that in mind. And then we have, whatever, oil services. Here's the semiconductors, and that's a pretty important one. And you can see just, here's the retailers looking a little better than the semis, right? And the semis are usually a little bit more bullish when they're starting to break out. So I would say that the problem that the semis haven't been able to break out is a bit of an issue. And then that, if we go to retail, I like that chart a lot better, obviously, just higher up and getting through the moving averages. So this just basically allows you to toggle, and it stays on the top one. So it'll revert back right away to the airline one after you've been on something for a little bit. So anyway, here's your chemicals and commodities. Beautiful chart, drilling in the bottom corner. And speaking of drilling, let's go down to the oil because it's having a bit of a rough go. The oil index had tried to rally briefly, and then today gave a nice big reversal. And guess where it gave it? Let's go back to that chart. So what you see on this is right at your moving average. So not very good. I think that's probably a 20 period, and this is probably a 50, and this is 100. So or 200. So anyway, with that, not great. And so we need to keep watching those. Anyway, just so you know, so on this homepage, you go up here to the chart view, and table view is the old way to look at it. And there's no right way, just whatever way you prefer. But you can also just highlight over these and run through them this way, or you can actually have that other chart with moving averages and all that kind of stuff from the chart view. And then also when you're in that beta mode, you can go and try and set up other settings for it, like this is defaults to intraday, and you might want to pick a different time frame, etc. So anyway, I'll leave that with you, but market summary, and then where would you find that? How do you get to it? Just to start with, so from your members dashboard, it's a big button right here, and it's also over here in the tools section, market summary. So anyway, give that a whirl. I think you'll find there's some nice data there. Okay, so what I wanted to talk about next, I mentioned that I wanted to talk about the overall indexes, and we're at a really important point. So we have been below the 40-week moving average, and now we're trying to bounce up. And if we just go over here to previous lows, so here's 2015, 2014. So in 2014, we came down, we kind of tested the 40-week from below, bounced right through it, and came back up. And got to the 10-week, went right back up. This is a weekly chart. And so we continued to cruise along. Then in 2015, what happened there was we held support at this 40-week moving average, but then the 50 started to kind of become resistance. Yes, we were above it, but for the most part, just kind of couldn't really make any new headway. And then we fell below. And as we fell below, then a rally back up to the 10-week here failed. And then here it started to take off. And then late in 2015, we got stuck under the 10-week. And then we stayed under it all the way to here. And then it kind of became bull. So if you look in general, just the 10-week is not a bad place to look. Now you can see up here it went above it. So the moment it goes above it, does that make you bullish? Well, it would be hard because this pulled all the way down, bounced up, down farther, and then up. So anyway, the problem is when you get back up to the 50-day, you start to get near the places people want to sell when they were long and got trapped long and now have losing positions. So everybody who bought basically in August and September is probably in a losing position or close to it on their overall portfolio. So we're bouncing back up against the bottom of this 10-week moving average. Now, I mentioned the other day, I have a friend, and he doesn't think we're going to see this low again for, 6, 7, 8 years. So he thinks it's the biggest buying opportunity ever. I got another tidbit from somebody else who says the sentiment index is so good, it's way down at the bottom. And I noticed that the bounce has only lasted 3 weeks and then went all the way back to the bottom again. So here we're 2 weeks off the low. Anyway, my point would be, be very careful when we get below the 40-week moving average and we start to test back above. We still have to make sure that we actually get back above and can get into smooth sailing. And there's nothing saying that, we won't get a good rally. And if we did, I would just draw a trend line on this PPO. And if it got anywhere up near there, I'd probably be expecting more trouble. But we've been pulling back for about 6 weeks. That's normal for a place to start a rally from. And if we got a rally, then obviously getting through the 10-week would be an issue, and then getting through this 2,900 level would be a lot of hard work. Okay, so let's go talk about some of the breadth indicators and some of the things we can learn. So back in 2014, 2015, you can see that we had trouble making net new highs, right? So the difference between number of 52-week highs and the number of 52-week lows gives you a number, and we plot that number every day. And what we see here is that in general, in 2014, 2015, we couldn't get much above 100. And this is on the NASDAQ. And then recently, we pulled back and we came all the way back down, and now we're bouncing back up. And what you can see is when we got into the big part of the market pullback in 2015 and ending in 2016, we really couldn't get more than 100 stocks on a bull market signal, or sorry, on a net new high signal, 100 more than lows. And so as this rolled over, that becomes pretty important. And I think we all know that the oil sector is struggling right here a little bit, with crude off, a full $16 or something like that. So what I would like to propose here is that on this bounce up, just keep watching this net new highs and its $ NAHL, and just make it a solid line. So the settings down here. So just solid black, and I have this horizontal line on here just pointing out the 100 level. But the idea behind that is just keep track of how many we get, and then you can do the same thing on the New York for high low. And just, again, back here's 2015, and you could just see we could never get above this. And so the problem is when you're looking at this data, just you need a reference point. You can see all the way through 2018, even though we were making higher highs, that January high was a pretty big deal. And as we fell down now we're making lower highs and lower lows, right? So we have this high, then we have this low, then this high, then this low. So on the big picture, we've kind of got this negative market dynamic going. And if you look over here on the left, high, low, high, low, high, low. And that's what happens is you fail to make fresh new highs. And so you start to make lower highs and lower lows. So currently we have that clearly going on. We have a lower low and a lower high. And so now we're expecting some sort of a bear market rally. And where do those usually end up? Around the 10-week moving average. And, pick one 20-week, 30-week, just go have a look at the different moving averages. And, I have a setting, so let's just go get some stock. It doesn't really matter which one. But the idea being just, take a 60-minute chart. And what you see, this is just a 100-period moving average. And when it's trapped around this 100-period moving average, it's going to struggle. And this is AMD from $33 down to $16. So October was a 50% drop. Now it's retraced somewhat, but it's still struggling to get back above like it did in here. Anyway, put that up on your charts and just have a look at it. And if you start to see something break out, so let's use Amazon, right? Had really ugly lows, and then it started to bounce out of there. And so it's trying to get back above, and you can see prior resistance up around this 1800 level, 1850. So it's going to struggle to get through here. Now, if it does get through here, obviously, and I think it's still a great company. I don't think it's going anywhere. But you might have to live with a pullback down to this 1500 and retest the lows or something like that. So just be aware on here. If it can't hold this 100-period moving average, you're probably going back into some sort of a retracement. So your stop needs to be relatively close when you have these down sloping moving averages. Now, in Amazon's case, on a 60-minute chart, it started to turn up, but it did that obviously in here too before rolling over. So anyway, just be aware of that. Now, on the bigger indexes like the S&P 500, and this is just a 60-minute chart for 2 months. And you can see we're back above the moving average, and we've got it turned up, and everything is looking pretty good, except we have a PPO that's starting to roll over here, but we still have higher lows and higher highs, which suggests, at least until we see some divergence, we'll probably be able to continue that. So, while the trend is up, I think you want to be bullish, but obviously, the one thing that happened, somebody said, we had the biggest rally yesterday since October 2015. Okay, well, let's go back to that chart. October 2015. So right here, so we had this, and then we rallied up, and we basically got back to the prior highs and then rolled over again. So anyway, it tells us at least that we're in rally mode. Now the question is making sure that when you're in rally mode, you keep moving up your stops and make sure that if the stock is going to kick you out, let it take you out. Don't be stubborn. Okay, so the big thing that in general, the breadth is trying to tell us is we were very oversold and we're bouncing. And so now we've got this issue about how many stocks can join the party and get back to making new highs. And if, as an example, if energy is going to be a problem, so that's going to restrict the number of new highs on one particular industry. And we could go through and try and analyze which industries are really weak. And you can do that with the bullish percent indexes. So here's the advanced decline line for the New York Composite going back 10 years. And I think this line basically reflects this line for the most part. this wasn't much of a pullback from here to here, and yet the market moved quite significantly to the September or to the January 2016 lows, and then made a final low in February. So with this big move down, I don't think there was a whole bunch of clues on the advanced decline line. I think your bigger clues are on the net new highs. And again, just keeping track of whether or not it can get back above this 100 level with some sort of spurious level. And that might tell us that we're more out of the woods than we think we are, and we're actually going to have enough power to rally. And again, I don't know the answer, but I can tell us, if we go to S&P 500 on a weekly and just look at the moving averages, which direction are they pointed? Well, this one's down definitely. The 10-week and the 40-week looks down. If we just turn on the Zoom box here. So when you have down-sloping moving averages, you just have to assume that the market is in bear market mode. And if it's not in bear market mode, then you're in bull mode, right? If your moving averages are pointing up, great. So I'd say flat, but right in here, the last few weeks in October here, we've actually pulled this negative for the first time since, back in 2015. And that was a good place to at least be aware of the potential for problems. Now, I put out an article, almost a month ago already about why I think the top is in, and it had more to do with Europe. It was the DAX was in trouble and stuff like that. So with this big breakdown on the DAX, and it hasn't really been able to rally out of this. So some sort of rally back up to the 10-week or the 40-week or whatever, just somewhere back up to see if the market really does want to fail here, and you get up there and you run out of buyers, and all of a sudden this thing rolls back over. So I think it's global weakness that would slow down the U.S. more than anything else. And so we'll have to keep watching to see how that unfolds. Okay, looking at the sectors, so everything in the last week has bounced. If we just take this and look for the last 2 days, energies obviously had a pullback, crude getting down around $60 even. And one thing that Jim Cramer said is, I could see oil around 40. And, when we get those statements so far away, so that would be oil falling $16 already, going another, $20 below here. I think we all remember Dennis Gartman saying, I'll never see $44 in my lifetime, and crude was at 25 or something, and it was only 6 weeks later, and oil was back at $44. So the point I would say is, once the bearish sentiment really kicks in there, be careful about getting too negative. Now, I've been saying for a while, I think last week on the webinar, I mentioned oil looked really weak, and be very, very careful. And for the most part, it's lived through that, or it's demonstrated that. So here's the chart of oil, and it's pretty much in free fall. And if we go look at oil, over here back in 2015, it came down hard, bounced up somewhat, and then came down hard and went all the way down to $26. So the fact that this support has broken, everybody's saying, okay, oil goes to 40 because this is the next support level. It could also stop here at the shelf at 55 and bounce off support. And I get it. Too much supply, not enough demand, the whole story. Just let's follow the charts and see what's going on. And the one thing that I would say here is, our PPO is coming down to 0. That's kind of where it bounced last time, and that gave us a pretty good entry. And in this chart list, actually, I have this nice little chart that we've been using for energy, and it's been pretty helpful. Not quite this one more, I think. And on this chart, what it does is it keeps track of the momentum of the bullish percent index. So a bit of a problem is it's an indicator on momentum index, and so that's normally you want to use an indicator on price, but this has helped us really pay attention to this market pretty well. And what you see is when the market gets really oversold down here, you don't want to continue to be bearish because this actually continued to drop for quite a bit more, the bullish percent. So we would be using the scale over here on the left, not the scale on the right. That's why that's blacked out. But what we saw is as this is the XOP chart, and hidden in the back is the bullish percent index for energy. So if I turn that on, let me just change the opacity to 1. You'll see why I don't leave it on, because it's just so noisy you can't really read it. I think if I showed you a chart like that, you'd glaze over. So we'll just make the data go away, and we'll just use the momentum trend. And the point I want to make is that when this gets this deeply oversold and we're down here, it doesn't get much deeper. And so now what we want to do, rather than being really, really bearish, I mean, whatever, if you're a person who likes to short, you could still short or something. We haven't got even a J hook on this yet, any sort of turn. But I think the bigger issue, and we've got a trend line here that's ready to snap and all that kind of stuff on XOP. The bigger thing is as this comes down, then we want to be ready. And like June 29th, this gave us a positive cross for the first time. So let's just go look at crude oil on June 29th. Sorry, go back there. This was June 29th, 2017. So here's crude oil. June 29th, 2017, not a bad place to get a bullish buy signal. And once we got that, obviously that was a pretty nice place, not only for crude, but for everything else. So if we just scroll up to the top and put in here, whatever, XOP or XLE, all of these did very, very well in that time frame. So here's XOP, and it actually rallied a little bit and then pulled back and then went on a big run. So $28 to $39 is $12 on 28, almost 30 or 40% in about 6 months. So pretty good run. My point would be that the bullish percent index is going to be one of the ways we know. And right now it's currently just registered, a very big low around 667. And you can see looking across here, those are meaningful lows when you're down in the 5% level. That's a good place to not be too bearish. I mean, it can fall further. I get it. But I think the bigger thing is keep a shopping list for what's going to start turning up, because the best part about these commodity stocks is when they do turn, they make big moves relatively quick, and you can make 10, 20, 30, 40, 50% in months instead of years. So I think there's a huge opportunity, being aware that we're getting set up for this big negative move down. And again, it could keep going for another couple of months. But we're at the point now where we want to be watching for the long setups and have all of the names of your favorite stocks. So in order to do that, what we do is we put all of our stocks in an oil and gas exploration list, and then we keep track of them. So currently, this is the some of the stocks over the last week are down 50%, but look at what the price was, almost nothing to begin with. And here's one that's 4 cents and it's down 44. So let's not look at those kind of stocks. Let's find bigger numbers, like in here. Here's the close at $18. That makes more sense. Here's one with a close of $26. And you can just slide over and take a look at the chart. And I get it. These charts are ugly, but I published an article earlier saying stay out of energy for a while. And now I'm saying you don't have to be in energy, but you definitely want to be aware that you're getting near the bottom of it. And so if we just sort this on either volume and scooter ranking, what we're going to get is, you can see that over the last week, these really, this is a positive change of 9%, a negative change of 8%. And these are based on some of the strongest stocks in the energy sector. And again, it's not compared just to the energy sector with the scooter, it's compared to the broad market. So I think there's some really good names here, and you don't, again, don't get too negative on these things. If they give you a chance, then you kind of want to be ready to rock when they start to turn around. So if this is going to pull back all the way to the bottom of that range, I think you want to be a buyer, not a seller. Okay, so we can scroll down here and just see what happens. And so when we rank by volume here, we can try and find some others that have large price. So here's ERF. And Enerplus is a Canadian company. This is traded on the US. You can see that's a pretty big fall from grace, down roughly 30 or 40% in a month. So, is it over? I don't think it's over, but I think what's more important is just being aware that as things change, you want to be ready to get on the positive side and have all of your stocks picked out. So as they start to rotate up, you can get involved. Okay. Lastly, I want to cover off marijuana, and the only reason I want to cover it off is because the moves have been huge. So this Tilray yesterday was up 40%. Come on. There we go. And so you can see the stock just going vertical from 90 to 140, and then today, dropping $15. So these are very volatile. But if you just look at that chart, just standing back as we are right now, what you see is a lower high and a lower low, and now a lower high. And typically, that's how these parabolic moves break down. And so, again, I'm not trying to tell you which way to trade it. I'm saying that the current look of the big picture is down. And so what you want to be aware of, don't get me wrong, the swing trading is awesome if you're catching some of these moves of 20 and 30%. But we've just had two major catalysts. One was the Weed Wednesday in Canada when the marijuana was legalized. And we just had the election in the US where more states asked citizens whether or not they wanted marijuana legalized. So that's kind of behind us, and now you almost have to wait for the legislation to roll through. And when Jeff Sessions stepped down yesterday, a lot of people thought he was the antagonist that was stopping pot from being legalized. And so all of these stocks rallied big yesterday, but then today they all let go again. And it doesn't really matter which one of these stocks you pick. A lot of them have this lower high, lower low setup, especially on the big names. And so I would encourage you to just be aware of how to trade parabolic stocks before you get involved. And this is just an ETF showing the marijuana names. And the point is, this rally from 14 to 26, just about 100% in 4 weeks, and then basically gave it all back. And now it's about halfway up. So if you were so from here, you made a higher high, now a lower low, a lower high. And if one started to head down this way, be very prepared that this could end up being the market rolling over. I'm not telling you which way to trade it. I'm just saying this is not the time to get fully invested in marijuana stocks and think that they're going to the moon. These charts usually need to reset more like after this parabolic blow off, they worked their way lower for a while, then kind of up, then down. And then this was almost the buildup into Weed Wednesday, which was October 17th. So use the charts to help you. And my big point here is you're near resistance for the average, right? For the ETF here, you're up around $23, which I would say is the base of the topping structure, and in this case it's a double top. So use that information to just try and trade gently, and if this is going to start falling away on you, just let it go and try not to ride it down. Okay, and so with that, I want to thank you for taking the time to join me. The Final Bar airs live on Thursdays at 5 p.m. Eastern. It can also be found on StockCharts TV schedule at other times during the week. In addition, you can look for it on the StockCharts YouTube channel. And with that, have a great weekend and good trading. Don't forget to pick up the book. It's on that StockCharts bookstore. Price is free, so that's a pretty low number. Anyway, thanks everybody, and have a great time out there. Good luck. Bye-bye.